Welcome everyone. Money Mondays with Marcus at Complete Wealth. Today we're going to have a look at some of the topics that have come up recently, and the most recent one is the budget. So we're going to talk about that today. I'm going to welcome Matt Batty, our CEO. G'day, Matt.
Marcus, how you doing?
Matt's our resident expert on all things, so we're going to get his rundown today on what the budget means for us, and if is it a normal budget or is it something special. So over to you, Matt. What quick summary of it, and then go through each of the steps.
Yeah, I mean, it's a bit different to the budgets of, a decade or so ago where, leading into the budget, we're always a bit nervous about what, actions we had to take before budget night, and then, what have we got to do in the last 6 weeks between, May and the end of the financial year.
All the changes to super sort of thing
thresholds
that
and, new things and whatever coming in. So obviously this is a bit early because we're in election year, so they've brought it forward. And it's an election budget. So there's a bit of spending, probably not as much as you might see in a normal pre-election budget, but I suspect there's a fair bit more announcements coming, as the election campaign starts, which is probably only now, officially probably only a couple of weeks away. So there's a couple of things in here though that does change the planning aspect, but I guess the good news from a strategy point of view is there's really nothing in here that says we need to rush out and do things right now. So we can digest the key pieces over the next sort of 6 to 12 months, as a normal sort of course of action with clients.
Yeah, we're not going to get too political about what was brought up in the whole budget thing. Just go over what they announced and what it's for. So, like some of the tax changes, have you got a bit of a rundown on those?
Yeah, so probably the two main ones there is a cut in the fuel excise. So fuel, obviously the price of fuel has gone through the roof in recent times due to the increase in the oil price. And so, that's a bit of a political hot potato. So you're probably looking at around sort of, $12 a tank, that sort of saving in fuel. They're cutting it from about sort of 44 to 22 cents. It's a temporary measure. So, and it's not, in the grand scheme of things, it's not going to make that big a difference. But it's one of those ones that kind of just sounds nice politically, I think. So the other one was an increase to the low and middle income tax offset, which was due to expire. This has been around.
I was just about to say temporary measure anyway.
Yeah, that's right. So this is the last year, and they didn't. Well, at this stage, they haven't announced any extension to it, but increasing it by another $420. So it's an interesting one though, because these sorts of rebates, if you like, do change effective tax-free thresholds for clients. So it is, while it can seem a little bit minor, it can play out reasonably well when it comes to tax planning, and particularly things like family distribution, some of those sorts of things. So, and also people who are retiring or having larger realised capital gains years, all those sort of things. So it does actually, even though it's not that much money in the scheme of things, it can actually play out to be a quite effective way to take advantage of normal tax planning. So that's probably something that we will plan a bit heavier for for most clients. But there were no changes to the tax thresholds or tax rates. There's already a third round of those that are legislated to come in sort of 24-25. So no changes with those.
Yeah.
They'll still come in at this point in time.
Yeah, just thing out on the low income tax offset. It's the difference between a rebate and a deduction. So it's not a deduction off your income. It's just a rebate off the amount of tax you have to pay.
Yeah, so it's the actual money. So if you're eligible for the full amount, you'll get the full $420 in terms of reduced tax.
Yeah.
But it's a tax offset,
so
it's reducing tax you would pay.
If you owe tax, you're just going to owe less tax.
Yes, but if you're not paying any, you're not getting a bonus.
Yeah. So that's what I mean. The people think they're going to get it, but it's only if you've it reduces your tax liability as such. So anything else that you found in the taxes?
Look, there's a few changes in some of the way they're administering tax, just sort of streamlining that. But yeah, in terms of dollars in your pocket difference, they were probably the main personal anyway issues coming out of the budget.
there's been some major changes with super, with contributions limits, which made all of the financial industry, really work hard up until the end of June. But yes, there's not many changes this year. Is there anything that we should be aware of?
No, there's no changes to the pension limits and even the superannuation guarantee that's already slated to increase from 10% to 10.5% next year. But what they did do is they've extended the 50% reduction in account-based pension payments. So, just to clarify, so account-based pensions obviously have a minimum payment they've got to pay at each year, which normally goes from sort of 4% up to 14%, depending on the age of the person, so of the pensioner. So they first tried this when as part of the GFC response to the GFC with volatility in markets. They brought it in also as a part of the COVID pandemic response, and what it means is you don't have to draw as much from your account-based pension as you would normally do. Now, the theory behind that is that if you look at the structure of most super funds, the way they invest across all asset classes within a particular unit. So when you buy into your fund, if you're in, say, the balanced option in a super fund, you're buying into a single investment that has investments in bonds and shares and property. And so what you do is you buy units when the money goes in, and you sell units when you take money out. So if you're selling units when the market's down, you're selling more units to get the same dollar, right? So we call this sequencing risk. So obviously when you get your return in your portfolio, when you're in the retirement phase of super, can make a big difference to how long your money lasts, because if in the early years of your retirement, when you've got the most money, if you like, if the returns are poor and therefore your unit prices are down, you're selling more units to then pay your pensions out. And then if the returns, as you get older, that your returns are higher because the market's doing better, then you're selling less units, but you've already sold a lot extra, if that makes sense.
Yeah. It's not going to grow as much because the base
because the units, you've got less units, right? So we call this sequencing risk. So you might end up with you and I might end up with the same average return over our retirement, but because in my early retirement, I got better average returns and then I got worse average returns later, and you got the reverse of that. I sell less units in my early years of retirement and you sell more. So we call this sequencing risk. So it actually does and can have a very profound impact if you look at how well your money lasts over a long time. So in one way, the government is attempting to address that particular risk, if you like.
Yeah, people don't have to sell down now.
The problem with that is, I don't know about you, but I don't live month to month based on how the share market's going from a cash flow point of view. The bills just turn up and you've got to pay them. So generally in retirement, what you want is you want that steady cash flow. And so one of the reasons why, in terms of the way we manage portfolios, is we ensure that we use our growth and stable pool sort of philosophy to ensure that the cash is available and we get access to cash flow to make sure pension payments, I don't have to be taken out of,
stable
right?
pool,
They're not even taken out of those. So in that sense, that's really the only way to manage, or the best way anyway, to manage the sequencing risk anyway, because you don't want to be living based on market volatility, because the markets can always be volatile, from year to year.
Yeah.
So in reality, I think, while it might seem like a good move politically, really the only people who can afford to sort of take advantage of it, if you like, are those who don't need to draw it anyway. So those who are more funded. So in fact, it does actually give us, where clients have investments in their own name, and there's big differences in account balances, or there's big age difference between partners. It gives us a lot of things, a lot of levers we can pull around strategy, which we've been doing in recent years, and so we'll continue to do that. But in terms of what difference it makes for most people who are, just in that sort of drawing retirement and are in those funds where they're subject to that sequencing risk, I don't see it being of a great deal of practical help, because, in theory, that money they drew out, they could just invest back into the market anyway and not be subject to that risk if they could afford not to. So, it's an interesting one.
That's the problem when people take it out and leave it in cash, because or
they've got to spend it, right? So they're not addressing the problem by, yes, they could draw less, But at the end of the day, you need what you need to live. So so it's an interesting one. It's one of those ones that I think is, I kind of understand it from a political marketing perspective, but from a practical point of view, it's great for us because it allows us to apply more strategy than we would if they didn't do it.
Yeah, oh, well, very interesting. There's one thing that I noticed that's not in the budget, but it is definitely coming in from the 1st of July, which I don't want you to go into, but it's the changes, something we might do another session on one day, is the changes to contributions and the bring forward rule for the people over 65 coming up.
We should do that. There's some changes that were announced a while ago that are coming through.
Yeah, but not in the budget, but the people might raise some questions out there and we'll put something together for them about it. What else in the budget? What about a bit of the social security payments for the people who won't get the advantage of the low income tax offset?
Yeah, so there's $250 for people who are receiving basically Centrelink support. But this is cash, unlike the tax offset, this is cash. So everyone who's eligible will receive it. It's a one-off, it's a cost of living expenses. I guess I can't help but think to some degree, it's somewhat ironic that a government's paying out money to help the cost of living increases that are not unrelated to the fact that governments have handed out a lot of money and printed a lot of money, and not just in Australia but around the world, which is the reason why, one of the main reasons we're starting to experience this inflation sort of kick. So it's a little bit like doing more of the same thing to fix the problem you've already helped create. But look, in the short term, certainly politically, it's obviously very very palatable, and leading into election, sort of not a bad idea from that perspective. But they're relatively modest. They're one-off payments. So we'll certainly help. Obviously pensioners, $250 can be a lot of money, especially if you're living on full pension. So and not only that, I guess it's also important to recognise that pensioners have already got a bit of a boost with the increase in the thresholds. Obviously, the thresholds increase in March and September each year, and with inflation being a bit higher, those thresholds have increased a bit more than they have in recent years, which will. Many people
noticing the
through.
Payments.
Yeah,
going up. Yeah. Like hasn't hardly gone up at all the last 4 or 5 years because
inflation has been so low. Yeah, but I guess it's also important to recognise that the measure of inflation, as being the CPI,
cost of living,
that's not really a great reflection. Or particularly people who are retired and living on the pension, because what you spend your money on, it's the inflation in that basket that matters, not the total basket, if you like. And we do know that the older we get, the things that older people tend to have to spend their money on, they're the things that are actually are increasing at the higher rate. And so there's many people experiencing cost of living increases that are far in excess of the CPI. So a bit of a bonus for them certainly isn't going to go astray. And the other big thing, the other main one, I suppose, more at the other end of the scale, is the changes to paid parental leave. So that's really more of a tidying up and increasing some flexibility. At the moment, there's some people who are missing out on payments there simply because of one person's income's a bit high, but the family income's not that high, or, depending on which spouse is sort of looking after the kids.
Or the father gets 2 weeks only and the other mother gets 18 weeks.
Yeah.
So
going to build that into
change.
Build that into more of a 20 and pro rata. So it'll be interesting to see the detail of that as it comes out, but at least it does make a bit of sense to recognise that it's, does it really matter which one's taking which time off? You may as well, give the flexibility there for couples to make that decision themselves.
It's something that they've kept tinkering with since they brought out the baby bonus back in the early 2000s, and then they said, no, that's not working. So, they just keep tinkering with it. But what about small business, and that a lot of digitisation was a word that I heard a lot talked about last night in the budget reviews. What are they meaning by that?
Yeah, well, obviously, the increase or the move to a sort of digital economy or digital revolutions and innovations, etc. I mean, technology has has more of a chance to create exponential economic benefits than than many other, say, transformations in the past. And so I guess the government's sort of trying to take advantage of that. We've seen a lot of very high quality businesses from Australia go offshore, and a lot of businesses in Australia not be able to take advantage of improvement in systems and because of the relative cost of doing so, not just in in changing the way they do things, but training their staff and employees in general to handle new technology sort of thing. So this is there's a boost here of an increase in tax deduction for that sort of expenditure. So rather than just getting 100% deduction, you'll get 120%. So it's targeted at small businesses sort of less than 50 million turnover. Yeah. And it looks like, at least from the announcements, it looks like it's going to be towards potential training as well, not just for expenditure on sort of software or those sorts of things.
So, give us an example of what a business out there now would would not be doing, and then so wouldn't be doing, where they could take advantage of this. So they're talking about businesses that still send letters out to clients, are they, or they digitisation. I suppose it's a word out there that the government seem to say a lot and all that, but I think the average Joe knows what they actually mean. Just use the internet.
Just Google more. So look, I think the focus of this seems to be use of digital technology, software, largely, to better improve either the efficiency or the productivity or profitability of businesses. And it might be as simple as saying, look, a lot of businesses run on software or processes, whether it's CRM or inventory management or even things like information processing, like bills and bill payments and those sorts of things. There's been a huge change in the way businesses can operate, and in that space. And so, having the time and effort required, especially if you're a small business, to be able to take advantage of those things. Sometimes it just takes a little bit more incentive, because a lot of businesses won't have had the opportunity or the time to sort of sit down and realise just what a big difference it can make. And a
lot of efficiencies could be made if they spent the training staff.
Two things. One is updating the systems and using new software or new processes to run their businesses. But also less reliance on staff. We keep in mind we've got unemployment at near record lows. There's
no one else.
Yeah, we've got workforce participation at very, very high levels as well. So there's not a lot more labour to bring into the market. As the borders open up, we can bring back the sort of 300,000 people that kind of left under the COVID scenario, which that in itself would make a reasonable sort of difference. But there's not as much labour capacity in the market as you would like if you're looking to, grow your economy, as strongly as possible. So anything that you can do to improve productivity, is obviously, is going to have a leverage effect in terms of economic growth. So, and look, Liberal governments in general are more focused on we'll grow our way to prosperity as opposed to, other sort of, austerity measures or some of those sorts of things, for example. Yeah. So I think the idea here is, if we can give them a bit more incentive to look at investing in new technology and training their staff to use that technology as well, because obviously, there's no point giving someone a new tool that they don't know how to use. So that seems to be the focus there. So look, a good idea. Will 20% make a huge difference? Probably not.
Well, I think there's some other ones that we're not going to focus on, but there's other apprentice and employment scheme things that are announced in the budget as well.
So a combination of those things is probably, will provide small businesses a lot more opportunity to, to grow and increase productivity, in ways that not only be good for them, but good for their sort of local economy and community. So, look, they're reasonable ideas. Will they move the needle? No individual one on its own, probably, but I guess it's one of those things that, keeping the right records and having good discussion with your accountant and making sure that you are taking advantage of what you can do. That's really, the most important thing, because you don't want to miss out on, on taking advantage of some of these opportunities, because they can add up to thousands, if not tens of thousands, over a year for a small business.
Yeah, I remember working with the government, and the problem that we had is the kickback from staff that they didn't want it, and that's the ongoing problem, from private businesses, getting staff to adopt all these things. It's pretty scary for the worker.
Well, it is I think it is when you first start doing it. But again, one of the things we're seeing now is that the pace of change is accelerating. So if you get used to doing it, actually, as you know, in working at Complete Wealth, is once you're doing that consistently, it's relatively easy to do. But getting businesses, down that path in the first place, sometimes they need a little bit of extra incentive. So, I mean, it's a good idea to push in that way, and it's a sort of thing that should, in theory, pay for itself through, better economic growth. The other one we should probably just mention on small business is the changes. I would probably phrase this as sort of the tidying up and simplifying to some degree, or expanding the opportunity for employee share scheme participation. So, one of the things, particularly in the digital and technology space, is quite common for startups and small businesses looking to grow, so they can attract the sort of talent they require, is to offer equity or offer a sort of more long-term incentives. So there's been a few changes. It gives them
incentive to hang around and make it grow.
Yeah, and get more of their payout in the success of the business as opposed to the work they do sort of up front. So,
good sort of staff retention tool.
Well,
really.
Not only that, but it allows you to attract staff that you just wouldn't be able to afford, and so the capital costs required to fund a business, paying $200,000-$300,000 a year salaries to high end IT people is just prohibitive for a lot of businesses.
Yeah.
So and this isn't just in IT businesses, but obviously that's where the bulk of this participation has been historically, at least, directed. So again, this is one of those things that this has changed a bit in recent years. So it's one of those things that if those businesses that have an opportunity for longer term, 5-10 year reasonably strong growth rates, getting that buy-in and participation and using those schemes to even attract the right talent can be really, really powerful. So it's good that they're sort of making that a bit easier to access. And so that's certainly something for businesses who are on that potential trajectory to look into as well.
Oh, well, it'd be beneficial to some out there. There's no doubt, but I don't know how many people will see, that many of them. Usually younger people, wouldn't they, at this stage?
Yeah, well, but it can also suit, sort of transitions as well as businesses. There's a lot of businesses that are setting up new divisions or setting up new ventures within organisations as well. So, it's one of those things that it's really, if you have a business that you would think, has really good growth prospects over the next 5 to 10 years, and you need to attract the right sort of talent, or you want to be able to reward or let your employees participate in that growth, especially if they're going to be primary drivers of it, those sorts of schemes can be really powerful. And so making them more available is certainly a good idea.
Oh, yeah, that's good. Well, that's everything I think we need to cover. You got anything that you think we might need to go over?
No, there was lots of other little bits of details, some housing affordability things, some lowering of thresholds in the PBS and those sorts of things. But I think, most of those things are sort of, for most people, sort of tinker around the edges. As I said at the start, there's not a lot in this budget, there isn't anything in this budget that's sort of, run in and do it now. It's more a case of, it's giving us actually some pretty decent sort of planning opportunities as we head into the end of financial year and into next financial year. So we'll certainly be looking at ways of taking advantage of it. But, all in all, it's a relatively business as usual budget from our perspective, from a planning point of view.
Oh, that's great, mate. Thank you very much. So we're going to put these together in the future and make them short and sharp. And if people have some questions that they want to send in, what should they do to?
Yeah, so we've set up an email address, moneymondays@completewealth.com.au. So if anyone's got any particular topics or anything they want us to delve into a bit more detail, I know we've got a few interesting topics lined up to sort of talk about in the next few weeks. So yeah, if
Yeah.
anyone's got anything in particular, then certainly send us an email and we'll look to cover it for sure.
Yeah, definitely. It's something we can just make them short and sharp and keep everyone interested and talk about what they want to talk about. I think is a good thing as well. So thanks very much for your time.
No worries.
I think that was really worthwhile. Cheers, mate, and we'll see you soon.
Thanks.
Goodbye now from Money Monday.